Welcome to the Beginner's Guide to Investing in Stocks. If you're new to the market, this video is for you. Let's start with the most important question. Why should you invest your money? Historically, stocks outperform almost all other asset classes. Investing in stocks has proven to be one of the best ways to build long-term wealth and secure your financial future. The S&P 500, which tracks 500 of the largest U.S. companies, has historically averaged annual returns of 8 to 10%. These returns are crucial because they typically beat inflation and the low interest rates offered by traditional bank accounts, all thanks to the power of compounding. Remember this mantra: time in the market is better than trying to time the market. Consistent, long-term investing, even small amounts like $1,000 monthly over 30 years, can lead to millions. To start your investment journey, you need to understand the basic language of the stock market. First, you'll hear about bull and bear markets, indicating whether the market is rising or falling. Market cap simply refers to the size of a company. Indices like the S&P 500 track groups of stocks. You have quote stocks, which are large established companies, and penny stocks, which are highly volatile and low priced. Dividends are a key term. They are portions of a company's profit paid out to its shareholders, essentially rewarding you for owning a piece of the company. Stocks are also categorized in various ways, primarily by size, industry sector like technology or energy, and investment themes such as AI or growth. Now that you know the basics, let's explore some strategies perfect for new investors. The safest starting point is investing in index funds or exchange-traded funds, like VOO for the S&P 500. They offer instant diversification and low risk. A popular strategy is the three-fund portfolio: U.S. stocks, international stocks, and bonds. This diversifies your risk even further across different assets and geographies. While exciting, investing in individual stocks is best suited for those with a higher risk tolerance. Remember that single stocks can be highly volatile, and even major companies can underperform for long periods. When you are ready to look at individual companies, you need to focus on the company's fundamentals. Focus on fundamentals like revenue, net income, the price to earnings or PE ratio, and free cash flow. These tell you how healthy and profitable a company truly is. It's essential to compare your chosen stock against its peers in the same sector. Also, don't overlook soft factors like the quality and experience of the company's management. Finally, let's talk about where to invest and see some practical examples. You'll invest using a brokerage account like Fidelity or M1 Finance. For retirement savings, a Roth IRA is highly recommended for its tax-free growth, with an annual limit of $7,000. To put this into practice, look for live demos showing how to build a simple dividend portfolio on a platform like M1, or how to buy fractional shares on Fidelity.